Started.
हाँ, क्लिक करना उस पर. Click it as Seema. Yes.
No, but chat I cannot do a Seema.
See if you can click this one अगर होता है तो. Because I thought कि okay. ठीक है. हाँ. इसका वो म्यूट कर देना. Hi Anoop, can you hear us? Please put it on the chat in case you are. We've just started a few minutes early, just to make sure that all the technology works. Super. So we are just waiting for a few more minutes, and really good to have you here. We've seen so many comments from you in all the different videos. So definitely, really good to talk to you, and it's great that you've learned a lot from us, and it's been helpful from your side.
Oh, thank you.
How did you come up with this YouTube name? It's definitely very innovative and creative, I would say. Hey Rahul, thanks. Good that you can hear us. We just started a few minutes early, so just to make sure that all the technology works, and we'll just kick it off in just a few more minutes. Yeah, that's the fun thing. Everybody has so many different personas, right? Yeah, online as well as here. So we have 6, so someone else also. Okay. Hi Mona, thanks for joining in. Okay, so we'll just get started. So thanks a lot for joining. This is a live Q&A session, so a first experiment from our side. So forgive us if there is any technology glitches. It reminds me of the first X Live that Elon Musk had organized, and there were so many problems with Donald Trump being there. So hopefully we'll have a much smaller audience, and we'll have a lot more interaction, hopefully. So no glitches. So what we are going to try and do is that we've received tons of questions through email.
Great questions.
Yeah.
Very good questions.
Yeah, so we will try and address those questions first, and then please keep posting your questions, whatever you have. We are going to record this so that we can put it out. So because it'll be easier for once we record it for us to club those questions. So that's why we put it in different categories. However, please feel free to keep typing into your thoughts as well as comments and questions. So Seema will try and moderate, and she'll keep bringing up some of those questions. Otherwise, once we've kind of addressed the questions that we've received so far, we will try and then address any remaining questions that have been missed out from the chat window. So please keep it coming.
So,
Um,
would you like to just, oh, first, before we start with the content, so thanks a lot for joining in. Welcome to all. And just say hi on the chat window. And from where are you joining? That would be great to know. And if you really like the format and like the session, please give us a thumbs up so we can do these kind of sessions more. If you would like us to do these kind of sessions more. Thank you.
Yeah, and also during the comments, please also provide your thoughts in terms of how we can structure it in future. We did quite a few of these community meets in different parts of the world. So this is one first of this kind
Virtual.
virtual. So hopefully, with your feedback, we'll try and make it more interactive. Right now, it seems that you can only see your chat comments, and we'll try and address them. Hopefully, we can do some kind of a bigger conference call kind of a situation in the future. So let me get started in terms of the questions that we've received so far through email, through Instagram, through the videos, the comments on the videos we pushed in the last few days. We've clubbed it into broadly 6 categories. So the category first one is the process and planning to retirement, our own process, and there are some questions related to that. The second is choosing where to retire. The third one is our retirement life so far, the good, bad, and the ugly. We've been sharing in the videos, but we'll try and address the specific questions that we've received in the last few days. The fourth category is the financials. As expected, quite a lot of questions about that. So we'll try and devote, considerable or good quality time there. Linked to financials is also the market volatility, the markets being, so-called all-time high and what's going up and down. So some questions related to that. And lastly, but not the least, is about healthcare. So there seems to be some questions about healthcare, long-term healthcare, family healthcare, etc. So we'll try and address those also, at least based on our feedback. And as we keep saying in most of our videos, we are also trying to learn. So please do put your thoughts and comments of the answers or whatever thoughts we have, so that we can also learn from you. All right, so let's get started. So maybe, Seema, if you can take the first one, because this is kind of a very obvious question, which is the definition itself. What does early retirement mean to you?
Oh, yes. Um, yeah, so I think in our view, what we have seen is that people generally relate this early retirement to age. So they talk about, okay, retiring in 30s, 40s, 50s, while in our definition or by our experience, it is more about, financial independence. So when you achieve financial independence, and then the choice is yours, whether you want to retire or not retire. So like we retired in our late 40s, and we actually got some comments on YouTube channel that late 40s is not early enough, so it's actually not an early retirement. So it's everybody's own perception. Some people want to retire in their 30s, some people want to work till 60s. That's absolutely fine. So I think by definition, early retirement is retiring anytime before your official or mandatory retirement. But again, what it means for us is the financial independence, that once you have achieved financial independence, you are financially secure. You can take a call whether you want to continue working or whether you want to retire or part-time job or different kinds of retirement.
Yeah, I mean, for us, we thought that end late 40s is a good time. You make your own decision. And as we keep saying in the videos, that look, it's the financial independence that you choose and basically pursue, because that defines whatever you want. Interestingly, just today I was watching the podcast with Morgan Housel, and he said very rightly that, look, financial independence makes you spend time with what you want to choose, buy what you want to choose, and even do what you want to choose. And if someone wants to work because that's what they want to choose, fantastic. So financial independence opens a lot of those doors, even at 30, 40, 50, whatever. The second link to that was that at what age did we decide to retire, and what is our assumption of life expectancy? So as I said, that we decided somewhere around our late 30s, early 40s that we want to retire early. We at that time already decided we don't want to work till mid 60s or late 60s. And that was also driven from the fact that we were living in Europe that time, and there is the whole pension discussion going on. So the age from pension started from 63, went to 65, then to 67. And that started putting that seed of thought in our mind that, look, do we really want to also push our retirement like what the state is pushing for the regular or so-called retirement age? So in our late 30s, we already made this decision. We at that time did not know that we'll retire in mid 40s, late 40s, mid 50s. So that is what over the period of time that came. And linked to that also, there was a question about, at how did we calculate our target expenses and our target corpus. When we made all this decision, honestly, there was no FIRE community as such, or FIRE was a very new word, or at least for us it was. And we were not able to tap into such community. So we made our own rudimentary sheet saying that, okay, if we were to retire in our late 40s or even mid 50s, how would it look like? And those rudimentary initial sheets, I still remember that we had not even put inflation, and we had not put a lot of stuff that we should have been putting.
Yeah, now you have ready-made calculators, so
Yeah.
you get all kinds of calculations and that you can do to calculate your corpus.
Yeah. So at that time, we didn't even know, say, withdrawal rate, etc. Forget, let alone even inflation, we were not putting in the sheets. But fortunately, by the time we were in our mid 40s, we had access to all these Mr. Money Mustache and big ERN, and we were very fortunate to have Carson on our channel a few months back, where we talked a lot with him, and he was one of the inspiration because his calculations about safe withdrawal rate, etc., did help us. And based on that, we said, okay, it seems to be that the so-called safe withdrawal rate seems to be 4%. We, like Seema said, we put it in a lot of calculators at that time, and we realized that, look, our numbers seem to be X, that if we are going to put a target corpus of X, then that should work. But then we realized that the 4%, like we've talked in many of our videos, is very much for the US market, or calculate back tested on the US market. We said our assets are not in the US or limited in the US. It's much more global. So that's where, therefore, we tried to put it between 2.5 to 3%. So based on that, we calculated our target corpus. We said, okay, if this is what and then based on that also, we started calculating our target expenses. And the good news was that we in the last 2 years of our retirement, we started living out our target expenses. So it kind of helped us fine tune that. So that is how we came about towards this whole target expenses and target corpus calculation. And by the way, really happy to see that there are folks joining in from the US, from Melbourne, so Dubai, so different time zones, and very thankful and humbled that you find our stuff good enough that you're doing late nights or early mornings in US and late nights in Melbourne. Going to the next category, and then we'll also address whatever questions you're putting over there in the same categories, but was about choosing where to retire. How did we come up to this decision? And maybe Seema, if you want to address that, what was the consideration in choosing a location? How did it go about it?
Yeah, so overall, it was not an easy decision because there are so many factors to consider. And but I think what the process, if I take you through the process itself, we had few countries listed like Dubai or Malaysia, based on our research that we have been researching that, okay, these are the places, these are the visas available and all. So Thailand, Portugal, Dubai, Malaysia, and India, of course. So these, I think, were the 5 short list. I mean, there could be a long list also, but you get all kinds of.
So, for example, when we were looking at the over a global list, that even interestingly, just I saw an article on BBC day before yesterday, where they have Costa Rica, Panama, Mexico, etc. We kind of put them out because those are very far off. We've never lived there. So we were more in Asia side. So that's the reason we came up with this short list.
Yeah. And then from the short list, I think then it was more about, kind of rating each and every location with certain factors which are important to us, like, quality of life, cost of living, proximity to family and friends. So for social life, community, that what kind of activities we can do. So medical support. And I think there are some other factors also, like what is the kind of weather. So we didn't want to be in a very cold country. We wanted to be more in a tropical weather. Food, for me, it's a big this thing. Not Indian food, but at least I have certain restrictions on food. So I just wanted to make sure that we get all kinds of different foods, and we like that food. Yeah, I think these were the main considerations, and then based on some practical things like visa, and so we kind of selected Thailand. And I think there is also a question about why Thailand and not Portugal.
Hmm.
So I think Thailand basically for us kind of rated highly on close to India. So our family is still in India, and we want to be close to the family because we keep going and visiting our family. So we wanted to be as close to them as possible. They can visit us, we can go and spend time there. So that was one of the main reason, but also our familiarity with the Thailand, because we have been here few times and we really like this place. Overall, the culture over here, uh, in general, the life. So I think that's why we decided on Thailand. We have been to Portugal after that. We really loved that place, but at this point I think we are still in for Thailand.
Yeah, and if we have to remake this decision all over, we probably, because we've lived here for almost 2 years now, and we've started liking it even more, because yes, we've seen the good, bad, and the ugly with the traffic, sometimes the language issues, etc. Um, Overall, I think with everything said and done, it's a fairly good place, at least so far. No complaints. And thanks, Mona. Thanks for your compliments, and really appreciate it. And
And
yes,
I love your name, your YouTube name, the corporate dropouts. I don't
oh,
know. That's a good one for our channel.
yeah, we should try and do that. You can, all the very interesting names that you have on the
Yeah.
channel here. And yes, by the way, we are still on LinkedIn. I think LinkedIn is becoming more like a Twitter or a Facebook kind of a tool. It's not that corporate as it was earlier. Um, and I will be addressing this point later also, with one of the challenges during retirement life is about keeping the network, at least the business network, and still keeping ourselves abreast to whatever is happening in the industry. So LinkedIn, we are there, and we'll talk
Yes.
about the individual stocks when we talk about
Hmm.
in the financial section.
So, I think we just, in our intro, we mentioned that this is our first ever live session, virtual live session. So, we haven't actually done any other live session because there is a question that why didn't we upload other
Yeah.
sessions? So, we did meetups, but those were the physical meetups in different parts of the world. But this is our first virtual live session. So, there has been no other recording as of now.
Yeah, and yes, we'll put our LinkedIn profile. I think it should be somewhere on our
Channel profile.
channel. Either it's on the channel details or it's in the use the fire exit blog. But we'll probably, if it is not there, we'll put it out over there. And there is a question about the safe withdrawal rate. So our safe withdrawal rate hovers between 2.5 to 3%, somewhere around. When the markets are high, then it goes down, because optically, your expenses are not going up, but the portfolio is going up. While if the markets go low, then it touches around just above the 3% mark. So it depends on the time of the day or the month or the quarter where we are, but it hovers around that right now. And we'll have to see that, do we need to increase this safe withdrawal rate, because that would mean we'll have to increase our spending. And that is something that I'll also talk about. Maybe I'll go into that detail right now, but in the retirement life itself, both from the activities as well as spending, etc. So maybe to start with, on the retirement side, retirement life, there are a few questions about how do we keep busy, our purpose, motivation, what do we do during daily life. So Seema, what do we do?
Well, this is first of all my favorite question because it always comes in that, related to, okay, yeah, now you have retired. What is your motivation? What is your purpose in life? What keeps you, or what, why do you get up in the morning? For what purpose? So I think we just, for me, the purpose, I mean, everyone's purpose is just to enjoy life in different phases. So even when you're, a child, you want to enjoy life, and you are studying, you still want to enjoy life. So we still want to enjoy life, but I think the purpose, the more important purpose, is that we want to do things which now we feel that
Mm.
they are meaningful, rather than something which is forced on us. Or it was a good corporate career for us, we had good jobs and good career, but Now we want to have the time, the resources, whether it's in financially or non-financially, but the purpose is mainly to do things that we feel like and we feel that they are meaningful. And those meaningful things are, for ourselves, that we want to do some physical activity, and we have discovered some new hobbies that we didn't know we could, we would love, like
Mm.
hiking. We used to do long walks and all that, and we used to count our steps, and we used to think that's enough. But when we started hiking, then we just want to do 5 hour hike, we want to do a half a day hike, we want to do full day hike, so we just want to do different hikes. And then sports, so we started doing some sports also. And we are visiting our family, we are doing much
Mm.
more socialization. And I think now we have realized, and that's maybe part of some other answer to another question, but
Mm.
one of the positive surprises of our early retirement is the time we have been able to spend, not only with family, I mean, that's definitely there, but with some friends. I mean, the kind of connection now we have with them is very different. It is not that we just say hi, hello on WhatsApp. It's like really spending time. They actually discuss their family issues, we discuss our things with them, financial things, non-financial things. So the kind of connection is
Mm.
very different,
Yeah,
right?
it's much deeper. So the definitely, I think with the it's added a lot of meaning with family, even our college friend,
Yeah.
long lost friend. So definitely, Sagar, thanks a lot for your comment and thanks for your encouragement. And Mona, Huahin, it's started to grow on us. Initially, when we moved over there, we were like, it's are we going to spend our lifetime here? So let's check it out. We so far it started growing on us. The main reason being is that we've been able to very quickly build a good social community. The reason is because there are lots of people with similar early retired digital nomads. So everybody is looking around for similar people. Everybody has time, much more time than just a 9 to 5 job. So we are able to meet a lot more, discuss a lot more. Interestingly, we've got different kind of groups. We've got a pickleball group, we've got even a group where we discuss about conspiracy theories in the world over beer. So all kinds of activity that helps us integrate much more over there. Then thanks a lot from joining for California. I think it must be very early in the morning over there, and I saw there was a question
Yeah,
about that.
I think I'll just, I think this was probably a question from Harshit only about the
Mm,
whole retirement, that what is the purpose, and,
mm,
how do we keep ourselves motivated? So I think that's something, once you love doing some things, like
mm,
we love hiking, we love sports, we love meeting people, we love, trying out new things, we love traveling. So that, I think that itself is a motivation for us every day. And yes, you need to have certain kind of discipline in your life. I mean, even pre-retirement or post-retirement, it doesn't matter, that you do not end up, like sleeping late and just watching TV and just saying,
mm.
okay, I'll do this tomorrow, day after tomorrow, next week. So yes, you would need to get out of your comfort zone. You will need to try new things, because if you don't try new things, you will never
Mm.
add up to your list of activities or things to do. So yes, that's what we have been doing in last 2.5, 3 years.
And stumbling and learning on that one.
Yes.
So moving to the financial side as well as so I'll maybe move to the questions that are there on the chat first on the financial part. So talking about planning withdrawals and
Yeah.
so we don't have an automated process. And there was also a question about that. Is the so-called safe withdrawal rate rule of thumb? Absolutely. I think you have to be. This is something that Carson also mentioned in the podcast that we had, or the dialogue that we had. And I was discussing with him offline also that he says one of the drawbacks of this whole safe withdrawal rate is people write it in stone. It has to be rule of thumb. You have to see how you, and that is also linked to the withdrawals that you asked about in terms of doing it like a paycheck. What we do is that we set based on the withdrawal rate, adding inflation to the expenses. We set a budget that this is the budget that we will have for our expenses in 2025, and based on that, this is what we have to achieve. So far in the last 2 years, we've seen that we are sticking to the budget of our expenses and actually being even below that. And that is something that we covered in one of the videos also that it's not easy to spend money, especially when you're retired and if you're not into buying cars and watches and bags, etc. Believe me, it's not easy to spend money. So we have been so far fortunate that we are sticking to this budget, and that budget, what we do is that then we see the cash flow based on the passive income that we have, that should we chip in into our corpus or should we withdraw it from the passive income. Again, there also we keep that flexibility. So sometimes where we think that that passive income makes sense to be reinvested somewhere, while something it is better to chip out from or from the overall portfolio, we do that. So we keep that flexibility based on the market conditions. And also, like one of the questions was about when we are rebalancing, what about taxes? So that is also defines our strategy, that where and what do we use at what stage, passive income versus the portfolio. And when it comes to taxes, again, if you are withdrawing or using dividends, then most of our dividends are coming from stocks where there is withholding taxes. So we can't do much about it. So it's kind of calculated that we kind of already withdraw from there.
Yeah, I think there are a couple of questions on our distribution, portfolio distribution. So, and kind of investments we have in US and in India. So, as I mentioned, I think this is a question from Sagar, that we do have equity both in US and in India. And our portfolio distribution, it has slightly changed from the last time we shared on the channel. I think this was our interview with Vint Wealth, where we shared our distribution. But now it's more like we have real estate, which is around 25%. So it has come down from 35 to 25%, because that's how we feel that, what is, the value of that particular asset. And equity is both, whether it's in US or in India, I think it's combined 50%. And bonds are 20%. So equity has gone up because we have also invested in many dividend paying stocks. So we want to have that dividend as passive income. And that is why our equity has gone up. And I think the rest is just 5% in liquid assets or gold.
And just to also mention, because there was one of the questions about individual stocks. So mostly we are not investing in individual stocks. We are investing in ETFs rather than indexes. Where we are choosing which index, etc., and how much dividend can we get. And we are slowly actually moving away from our previously held individual stocks towards those indexes, so that that rebalancing happens within that stock market. And because, for example, if you're doing from US equity to US equity, we don't have a tax issue because we are not US domicile, so we don't pay any capital gains on that. We are just moving money from one bucket to the other. But those dividends, yes, we do pay withholding tax, as I mentioned earlier also. Any questions about markets? Otherwise, we can continue with the questions.
I think it's about
so while Seema looks into some of the questions, I will address some of the questions that we got earlier. So there was a question about pensions, that are the pensions, for example, Singapore has SRS, we didn't have US, so we 401k, etc. We don't have any, but we did have some pensions contribution in India as well as in Europe when we were living. But we are not baking this into our overall business case just because the contribution was very small. One of the things of us continuously moving from one place to the other because of career is that we became those rolling stones, that we were not gathering that moss of that pension. So pension is not part of our overall portfolio. If it is for you, great, but just be aware that it will be somewhere down the line, and be careful, or be aware that how much pension can you really withdraw and how much you are just getting the income on that pension portfolio, especially in Europe, how it works. There was a question earlier about any question from here?
No, it's the withdrawal rate. You have already addressed that. What is our withdrawal rate? And because there are questions like, I think this is a very interesting question, which says that, do you find it comfortable withdrawing, and it doesn't bother you emotionally that you are withdrawing from your corpus, and how is your corpus growing? So that's
a very interesting point, actually, that that's why I also highly recommend, if you've not read it, read Psychology of Money, because I think I've realized, or at least we've realized over the last many years, that managing money is not just an Excel sheet. It's a lot of emotions that go into it. So the question that you asked, that initially for us, it was a little bit, and especially coming from this Indian background, that you're touching, selling your, savings. So it was difficult to withdraw from the corpus. But then we realized that it doesn't matter if, for example, we're getting passive income, we are withdrawing from that bucket or the corpus. It's about making that rational decision rather than an emotional decision at that time, that how it works. So that's why I said that sometimes we withdraw from the corpus, sometimes we use the passive income. It also depends on the cash flow. So for example, rental income can come on a monthly basis, dividend comes on a quarterly basis, fixed these fixed deposits, their interest come in 1 year, 2 year, etc. So that cash flow becomes difficult to manage. And interestingly, if you are within that 2.5 to 3% withdrawal rate, what we've seen so far, again, past performance is no guarantee to future success. We've seen so far is that the withdrawal rate is low enough that even if you're adding inflation, your portfolio will be growing. Assuming that the portfolio you're getting 6, 7, 8% return, which for the last 2 years it has happened. Again, if the recession happens, etc., there will be dips in the future. So that's why we keep saying anything above 4% puts you at a little bit of a risk, especially if you're outside the US. Anything between 2.5 to 3%, I think, should be comfortable enough not to run out of money, at least if you're putting your retirement of 30 or even 40 years. If you're planning to retire at 30 and if you've got 50 or 60 years to go, then it may be a little bit of a difficult situation there.
So a question from Mona, that is this withdrawal rate that we say 3%, is that including passive income or excluding passive income?
Yeah, so passive income, you have to start seeing it as an element of corpus.
Yes.
So what you should be, at least, again, this is how we are doing. I shouldn't say what you should be doing, and you can also tell us if we are doing right or wrong. What we've been doing is that every year we just add our passive income to the overall portfolio and say, okay, this is what our portfolio at the end of the year is. This is how the portfolio is in the middle of the year. This much of the portfolio growth has been through passive income. This much portfolio growth has been just the capital growth of the overall portfolio. So we don't treat passive income separately. And therefore, that is also the reason that when we are withdrawing, sometimes we withdraw from passive income, sometimes we withdraw from the overall portfolio itself.
Yeah. And there was another question about the withdrawal strategy. I need to go back and look.
Yeah, while you're looking into that, and please, if we are missing out any question, because the chat is scrolling up fast, so please post that question so that we make sure that it gets highlighted.
Yeah, there was a question. So I think it's not about withdrawal strategy, but more about the portfolio distribution. Was about, what is the expected rate of return that we are expecting on our investment. So, if let's say then, given this distribution, if let's say we are expecting 5 to 6%, changing that distribution would make it 8% or 3%. And that's...
It's a very good question. Actually, this is something that we also keep, because these are just the levers that you have. So our general target would be that every year we are looking at the portfolio overall growing with around 7%, 6 to 7%. This is our ambition. If it grows at 5%, because our withdrawal rate is 2.5 to 3%, our portfolio is net positive still. Keep in mind that our expenses already include any taxes that we have to pay. So we bake it in our expenses anyways. So that means that whatever we are withdrawing at 2.5 to 3%, that is including all our expenses also. All the taxes also. So overall, in summary, if your withdrawal rate is between 2.5 to 3%, and if your portfolio is growing by 5 to 6%, with the inflation calculated the next year on your expenses, you should be able to not chip away theoretically from the portfolio. If you're growing at 7 or 8%, that's what our ambition is. So far, touch wood, the markets have been kind enough that it is growing at that level. And that is also the reason that we rebalance. And right now we are, as I made the video, that we are rebalancing towards gold. So to make sure that we continue in that bracket of 6 to 7%.
Yeah. Yeah, so I
While
think
you
what
look
is
at the questions, some of the previous questions that we had regarding this was also a recommendation about the passive income streams, as well as there was a question about liquid assets versus agri or fixed asset. Let me address the liquid asset versus agri fixed asset because I come from the agriculture background. My father was a farmer, so we had agricultural land. Um, Overall, again, that's where you have to start rationalizing emotions. That over the period we realized that the agricultural land, because me and my brother, we had left the village, we had moved on, we were working, so it was becoming very difficult to manage the agriculture. And then we realized that the return on that for us as outsiders living outside, trying to get returns on that and doing backseat monitoring, was returning to maybe 2 to 3% per year on the yield of that. And the growth of that agricultural land was, when you compare to the stock market, was much lower. So we started rebalancing already over the years, and we moved with small little, and by the way, it's a small little piece of land, so it's nothing that should be a big number. But that is the other reason that I would say that liquid assets versus fixed assets or agricultural land. I'm not going to say that I encourage that you should move towards liquid assets or stock markets, etc. But you have to have a very good balance, and you just make sure that you're not at least emotionally seeing, even when it comes to a house or a property. Many times emotions overcome us versus just making a rational financial decision. If it's your primary place of living where you're living, there it's understandable you will have emotions, memories, etc. But if it's an investment property, you have to see it with a much more rational eyes. um, Addressing another question that we had received about passive income streams. So typically, we've had passive income streams of rentals, real estate rentals, dividends, and interest generally. We've added over a period of time, the fourth passive income stream is in terms of some private equity kind of small little
yeah, but
effort
that's
of
also interest,
interest
basically,
of
primarily to,
microfinancing
yeah.
more than anything else. But like Seema said, that we are moving away from the
Rentals. We are
rentals.
moving from more from rentals. I mean, last 2 3 years were very good for interest, whether it is interest on USD or in Indian market. So we got a lot of passive income from the interest, but now it's more between rentals and dividends. So we are moving part of the rentals passive income to dividends. So we are investing in stocks which are paying. There are different kinds of stocks where you have high returns and less dividends, but on the other side there are high dividends, but they are more or less stable. Not, not much growth happening in those stocks. So this is a kind of distribution we have for passive income.
Yes. And Harshad, the very good point that you mentioned about the expenses, and in terms of the hobbies and travels add up to your expenses. And typically, what we've seen or what we read before, and we are seeing in our own ways also, that the expenses are like a smile curve during retirement. That initial years you will have more expenses because all that pent up demand of traveling and pursuing hobbies, you want to do it a lot more, especially as we keep saying our go-go years. That's what you want to maximize. Having said that, it also depends what kind of hobbies that you choose. Like for example, we didn't realize during our pre-retirement years that we will enjoy hiking so much, we will enjoy pickleball so much, and these are less pricey hobbies in the sense that, compared to maybe us going yachting or golfing or even something else. So it depends on what hobbies you choose. So far, our hobbies have been a lot cheaper than what we would have
Yeah, in
wanted.
fact our holidays have become cheaper, so we when we are going to places which are not typical tourist spots. So
Yeah.
we go, and like even if we go for tourist spot, we just start the hike from there, and then it's like when we go to 5 to 6 10 kilometer hike, there is nobody over there. So, and I mean, also we are staying in small places. So small places means like small villages or something like that. So then the cost or accommodation cost is
Yeah.
also not that much. So I don't think our cost of traveling has really gone up. It has been more or less what we estimated. In fact, it has gone down by we discovering this round the world ticket, we discovering these Airbnbs that we enjoy and all. So it's really manageable.
Especially when you're like, even the last week we were traveling domestically within Thailand. So we traveled during the off-peak time, which is the weekdays. So you get a better deal. So that also helps that your time is you have a lot more time, so you can plan accordingly. So, and hi Deveshwar, nice that you're here. Didi, the withdrawal rate that we have is including taxes. So all taxes you have to bake into your expenses. And that is one of the things that we've spoken in many of our videos, saying that, look, optimizing taxes can either accelerate your financial independence or even put 10 years more to your financial independence, towards your financial independence. So for example, if you end up going from living in a place like Dubai with zero taxes and you go to France where there is almost 60% income tax, you can imagine there is a lot of talk about wealth tax, that they're going to put 2 to 3% wealth, overall total wealth. So imagine you going there, you end up adding 10 more years or 15 or 20 more years towards your journey. So that 2 to 3%, you have to see how do you make sure that you optimize your taxes. That's one of the biggest things. And for example, one of our reasons of choosing Thailand was also that it helped us optimize our taxes.
Yes.
Um,
What's the next one?
Here there's
what inflation is practical to put in FARC if 80% of portfolio is in USD?
Inflation is better to put in the place that you're living.
Because that's going to be the place where you're going to have expenses.
Exactly.
Yeah.
So inflation, see, what you put as a rate of return towards your portfolio should be the market where you're invested. And what you put as inflation towards your expenses is where you're living or where you're spending majority of your time. So if you end up spending majority of your time in India, I would think that you'll have a much higher inflation than you would spend majority of time in the US, which probably now is also getting into the inflation territory anyways.
How much was the drawdown that has happened from top last year?
How much of the drawdown that happened, percentage from the top last year, percentage allocation at present? Damodar, can you please explain the question a bit? So because we didn't understand it properly, maybe our apologies on that. Vivek, in the meantime, about the education system in Thailand, the primary education system, it's very good, but it's expensive because it's international education. So that means if you are choosing a local school here, which means that you will have to have your kids speak in Thai, or even the education will be in Thai, then it's free or very cheap, and very good schools. But if you want English and international exposure, then education is pretty expensive. That's what at least we explored when we were doing a video about the Thailand expenses a couple of months back.
So we can go to the next.
Oh, there was a question about capital gains tax. So again, capital gains tax depends where your capital gains are. So if, for example, your assets are in the US, but you're non-US domicile, then the stocks, at least our US exposure is very much equity. There is no capital gains tax as a foreigner. However, we do have withholding tax on dividends. If whatever we have in India, it's LTCG and STCG, depending on however it works. In Thailand, we don't have any local investments, but other markets where we have, depending on the place where. And one of the reasons we've chosen certain markets of investments is that we don't end up paying too much of capital gains tax and reduce that.
How you design your bucket? Yeah, bucket strategy, I think you're going to cover in the next
one. So let me cover it right now itself, because bucket strategy. So spoken a bit about safe withdrawal rate already. We have a 3-bucket strategy. Some people prefer 2 buckets. We've got 3-bucket strategy where we have the short-term bucket, the mid-term bucket, and the long-term bucket. The short-term bucket is our needs for the next 5 years. Mid-term bucket for us is 5 to 10 years, and anything 10 years plus is the long-term bucket. Typically for us in the short-term bucket is things like fixed deposits, very secure bonds, and even very blue chip stocks that we put it in the short-term bucket. Mid-term bucket would be S&P 500, etc., that we think that they were They are still growth, but they can be withdrawn. And the long term is things like real estate, crypto, or any other asset that we have, where we are at least even the startups, or we have an ETF on IPO, etc. So all those small cap go into that last bucket for us. So simply put, by rule of thumb, what we are following is that 5-year need of us in our expenses that comes into a short term. The 5 to 10 year, the next 5 years basically, that becomes in the midterm, and then beyond that is all long term bucket. So I hope this answers your question.
So the passive income is mainly coming from our bucket number 1.
A mix, right? Because real estate rentals, we've got the real estate growing in the as a capital, that they are all from the long term bucket, but the passive income they do generate right now.
Yes.
And some of the dividends also, they are generally the tech companies, they don't pay dividends. It's the real blue chip and the better companies, so they're all short term, mid term bucket dividends. Then there was a question about international diversification, the portfolio, and I think there was some comments about our personal exposure is in all different markets, because at least we believe that, look, if there is an opportunity, and many of you are in different parts of the world, so in Melbourne, in Dubai, and in California, and Riyadh, and all places, so you have the same luxury like we did to not just diversify in terms of assets, so in terms of equity, bonds, real estate, etc., but also diversify in terms of currencies and diversify in the markets. At least the last 6 months has proven that just putting all your eggs in the USD market is also going to be detrimental, because USD itself has lost, I would say, significant value in terms of the relative terms of USD as a currency being so robust. So that diversification becomes important, to have euros in your euro investments, if possible, INR, USD, and some other markets if you can. We've got SGD, we've got Thai baht also now. So that kind of, probably with this kind of diversification, will not get the growth like someone in the US who's invested all in NVIDIA, but at least we will also not fall flat if AI falls flat in NVIDIA, or any S&P 500 goes through a cold or a recession.
Yes, so there are a couple of questions which is about their individual portfolio. Okay. So I think these are the ones that we should take on one-on-one. I mean, that's
yeah, we can take it.
So I mean, I think there was a question earlier also, so we can have a one-on-one with them.
Yeah, we could do that also. And if if there is a question that someone wants specifically addressed here, we can do that.
Yeah, so I think we have got a couple of questions about personal portfolio. So I don't know how much we would like to discuss over here, or you want to share with the whole audience over here. We just know
reach out by email, and
reach out by email. We can set up a time, have a short call, and we are not going to we are not financial advisors, so it's not that we are going to advise that these are the investments you should be doing. It's only based on our experience. You tell us about your situation, and we can tell you something which is what we have also faced, or what our learnings have also been. So you can definitely reach out by mail, and we can set up a time for a call.
Absolutely. And then there was a question which also brings to the next topic, which is market volatility, which is about how do you buffer money for uncertain situations, including healthcare. So we'll probably address that also. So because there was a few questions that we got that, how are you protecting yourself or hedging against what's happening in the market right now with the tariffs and the markets going all up or all down? And some people also believe that the markets are on all-time highs. It's very simple. And that is also towards the question that I think, Manish, you asked about uncertain situations, is to make sure that you have an emergency fund and you also have this bucket strategy. Because what that emergency fund, and as we keep saying that ideally the emergency fund should be 24 months, as a minimum 6 months. If you're earning and you're still long way away from your retirement, and if you're nearing retirement, then definitely 24 months. That if there is any uncertain situation, that you have access to this liquidity that you can use for such uncertain times, or even in the market volatility. And at least the past data has shown that the volatility lasts for maybe 1 year, 2 year, 3 years, as long as we are not in that stagflation situation of the 70s that happened in the US, or that Hindu rate of growth, as it is called, during the 80s, or the license Raj times. That 5 years of your bucket one should help you be resilient against those uncertain market volatilities, as well as in some healthcare or any emergency situations that you may encounter in there.
Okay, so I think this was a question from Damodar earlier also. So what his question is about the distribution, which we have shared our distribution, portfolio distribution, and how much did it fluctuate from last year, right? So did it fall or did it, yeah.
So Damodar, interestingly, we had made a video around 3 to 4 months back when this whole tariff mania had just started and the market crashed big time, and it also made us jittery. So I think if we look at our overall last 6 months, or sorry, 8 to 9 months of our emotions going up and down has been, it's, we can say all over that, yeah, you don't need to be emotional, but we are all humans and we also got emotional, and the markets were volatile. But overall, if we look at the portfolio from year till date, I think it's been net positive. So with all the
Yes.
assets put together, and our ambition is that probably by the end of the year, we'll probably still target 6 to 7%.
Yes.
So I hope, Damodar, I answered your question. That yes, this is.
So I think the distribution, because a couple of people have asked, we have already shared the distribution, but our distribution is in real estate, we have 25%. Then we have 50% in equity, and that's the major shift that we had done from real estate to equity, primarily because we do not want, or primarily to move away from rental income to dividend income. And then we have around 20% in bonds, and the rest is 5 to 6%, which is in liquid assets or gold or such things.
Yeah. So I'll move on to the healthcare part of few questions, and then Seema, if you can scan and see if there is any
I
questions
think
we missed out.
yeah, there are few questions, but I think I would like to take that after we have covered the process part, because that's more like, let's say, what mistakes, what if we have to do it again, what different, how will we do it differently. So I think these are interesting questions, but let's take it up after we have discussed more about the process.
Yeah. So the next one that we had, actually one more question was about market volatility, is about lump sum investing, because quite a few people, when you get bonuses, like we also got, we both were from sales background also, so we got bonuses. So how do you invest those bonuses? Should you invest it over time? What we typically found, at least from our own data of the last many years of investing, is that, look, at that time, the market may look high, and you may say that, look, let me time the market and let me try and distribute it over a period of time, that over you will invest that bonus 10% each month, and you spread it maybe over 10 months. But when we zoomed out, we realized that on a 10-year, 15, 20-year horizon, this doesn't matter much. So you either invested lump sum on that day, even if the market is all-time high, and 10 years time, it will probably not make that much of a difference. It may make a difference in 1 year or 2 years, that when you're looking at just the isolation of that. So the answer would be that it doesn't really matter, as long as you're investing in a diversified portfolio. So if you're investing that entire 100% bonus in buying one stock, then you are definitely into a danger ground. But if you're investing 100% of the bonus and spreading it into 70% equity of that SPY and Sensex as an index fund, and 30% in bonds, or 10% in gold and 20% in bond, then you're diversifying. At the same time, you've got also the diversified equity portfolio, and then it doesn't matter over 10-year period about lump sums. Then coming to the healthcare question, there was a question by Manish, as well as earlier there were a couple of questions about long-term healthcare planning, especially any elderly care, that if you have elderly parents, how do you take care of that? So just to address healthcare as such, there are two parts of it. One is actually three parts, sorry. One is the insurance part, that how do you make sure that you're rightly insured and you are insuring rightly your family. The second is assistance for your health care or your health. And the third is caring for your health. Um, so if I take the last one first, is caring for your health. One of the things that we are realizing, and this I should have covered when we're talking about our retired life, is one of the surprises we've had is that, look, um, when you're working 9 to 5, you may think that you've got a very fit body. But when you start doing your hobbies, and especially start doing your physical hobbies, then you realize that, it's not as fit as you thought it is. So our uh, amount of activity that we have started doing for the last few years is maybe 4 or 5 times what we were doing in a 9 to 5 desk job, or just maybe even conference calls, etc. So all the hiking, the pickleball, the badmintons, everything what we are doing, we realize by the end of the day that the body starts telling you, the knees and the joints, etc., that there is definitely pain. And that is all the more reason that retiring earlier makes a lot more sense, because you may have this myth or this fallacy that, yes, I'm fit right now, I'm just mid 50s and I can there's a lot of juice, and in corporate world people keep saying that I have still a lot of energy and juice. Good. You may have, because you may compare that based on just the health that you have during your working day. But when you start pursuing all your hobbies and you want to travel, etc., and then you will realize that it's not the same. The body starts telling you back. So that's on the part of just taking care of your health. So the more you take care, the better you will be able to enjoy your retirement. Then the second part is that if something happens to you, especially when you are into your 70s or 80s, I hope it doesn't happen 60s, and you need some assistance. So honestly, it's a little bit too early for us, but so far we've evaluated India living in an assistance, and being there, especially with Seema's parents. Also, we've been able to see that what kind of assistance is available and how effective it is. And we are also evaluating in a country like Thailand. And so far, we've not experienced it ourselves, but we've seen others experience it, and it's not that bad. But again, we don't know how the future holds for us in 10 years' time. That do we use the assistance here, or do we go for in India, etc. And the last part is the insurance itself. So again, in the insurance, healthcare, we kind of divided into different buckets. So the first one is that emergency. When you're traveling, you need to make sure that you're covered for any emergency, especially when you're traveling expensive countries like US, Singapore, Europe, etc. So we try and get the best emergency insurance package when we are traveling, so that it covers us for any of those dire situations. The second is any major surgery that you may end up with. The doctor says, hey, you need to go through a knee surgery or a hip operation or even some organ transplant. So for that, we've got ourselves double insured. That we have insured in India, we've insured ourselves in Thailand. So at least we have a freedom to choose that where we think we want to get that done. So I would say that if you are even living in US, Australia, Dubai, etc., make sure that you start building your medical history. It doesn't cost that much, especially when you're young, to get an insurance in India for 3 years, 4 years, so that you build your medical history, that in future you don't have an issue that someone says it's a precondition. And the third is that if there is any minor issue that we've not covered in insurance. So for example, I got a root canal done in Thailand. So it cost money, but then it's something that we've budgeted it. Similarly, if there is something with parents, then from a major issue, we are trying to cover it with insurance. For minor issues, we are trying to say that, okay, we have that emergency fund that takes care of that. So I hope that this addresses a few of the questions that they were coming about the healthcare itself. Seema, any questions that we should
Yeah,
cover
we've
now?
got a few questions. This is more about, I think that's also an interesting question, that when did we think that we have enough corpus and we should just retire? And there is also a question, I think we got it through the mail also, which probably we have not addressed so far, and I see it in the chat also, is about the social pressure. I think that's more about that. What will people think that if you retire early? And I think I know that's more related to the culture in India, probably, and that's where it is coming from. But
Yeah.
Would you like to address that?
Yeah, so let's first address on the social pressure
Yeah.
side. Um, Honestly, we were pleasantly surprised, and that majority of the people around us, they were encouraging, in the sense they were concerned, generally concerned. So I have some family in village, I have Seema's parents in Delhi and all over. So our family, they were generally concerned that, they were asking very basic questions. What if you run out of money? Are you sure that you want to do it? So there was a genuine concern, but there was no mockery, or there was no, look down upon. It didn't happen. I think the society is moved ahead in a way that people said, okay, this is your choice. I hope you. Majority of the thing was that everybody said that, look, I hope you know what you're doing. So that was the kind of reaction that we got.
Yeah, I think we got support because, again, we have mentioned that in our videos also, that in the last 5 to 6 years before the retirement, you actually want to validate your decisions. And those are financial decisions, but also non financial. Okay, I'm doing this. Am I doing it right? And obviously, you can't do it with your colleagues, maybe you can't do it with a very close family, maybe. So you actually have
Mm.
few people you identify, and
Mm.
that could be, part of the family, that could be friends, that
Mm.
could be your colleagues, or somebody that you can share.
Yeah.
And this is also what we shared with them. This is what we are planning to do, and we plan, luckily
Mm.
got support from all of them, saying that, okay, this is where you think you should think, where we think that you should actually have much more thought process going on.
Mm.
um, have you thought about this thing? Have you thought about, traveling? Have
Mm.
you thought about the medical part? Because insurance, you are in corporate insurance. Once you leave
Mm.
job, you have to build up your own insurance. So have you thought about those things? So it was more a feedback from that point of view, rather than saying, oh, why are you doing
Mm.
this? This is absolutely, you should not be doing it. You should be working. You should be
Mm.
earning money. I
Mm.
don't think we got that
Yeah.
kind of
The surprise thing, for at least personally, that I found is the family and friends were very encouraging. The corporate world didn't give a damn, and the corporate world moves on very fast. So all your
yes.
network that you believe that you spend a lot of time with your network, ignoring your family and friends, and that's what we did. And that is the sad part of our life. And believe me, the day you will leave, within 6 months, all those connections that you have in the corporate world, they will dramatically go down. While the people in the family and friends, the interaction will become much more meaningful. So keep that balance alive. Make sure that. We got
Yes.
quite a few questions on
No,
that.
this
So,
one, the question about when we think the corpus, there was enough
oh yeah.
corpus and we should now.
Um,
Actually, we did not
so I
think.
think, as I mentioned earlier, that look, we made a very rudimentary calculation initially, that we said, okay, this much. And, you know, I think when we had just moved outside India in that time, not to sound like dinosaurs, but in the late 90s, we thought we want to make 1 crore rupees was our target, that someday our total corpus would be 1 crore rupees. And that came and went, and the next target came and went, then next target came and went. And yes, we continued growing as people, we also continued our lifestyle growth, etc. But then we realized somewhere in the last 5 years of retirement, pre-retirement, that our expenses are stabilizing, that we realize that this is the plateau at which we are happy with our life. And we said that, okay, if this is our basic expense, then can we live with that? And at the same time, this whole, say, withdrawal rate discussions and calculations also came in. We said, okay, if 3% is our target withdrawal rate, and if from our current corpus, or our, whatever we'll have the corpus, can we live with this 3%? And we tried living it with for 2 years before we left the corporate job, and we were successful to do that. So that is when we decided that, okay, the maths work, our expenses are flatlining now. That means this is the maximum. And so far, I think we've been almost now 3 years in, and we are not regretting the fact that we made the wrong corpus calculation, or we made the wrong expense calculation. As I mentioned earlier, is the other way around, that when you retire, and if you don't have crazy expenses, it's not easy to spend money.
Yeah, and I think we get this question many times about the corpus, that, how much is enough, and when do you realize that it's enough, and why not work some few more years, and have we worked on work, from a person's point of view, have I thought about the withdrawal strategy in the right way and all that. So there is those kind of apprehensions about your calculations, and that's, I think, absolutely fine to have. But the what we can say from our experience is just trust the process, that if you have done those basic things, like you have been earning, you have been saving, you have been investing, diversifying, bucket strategy, if you're doing these things right, that's the whole process, then things more or less will not go wrong, until unless you do some crazy things
Yeah.
like FOMO investing, and or just following one person's investing strategy or something like that.
Yeah. And also let the maths do the work for you. So
Yeah.
simply put, if you're in the 3% range, and if you can scope your expenses in that 3%, or you can increase your corpus enough to just be within the 3%, your maths will do the rest for you. So typically, again, the historical data has shown that your portfolio should be able to grow average. Some years it could be even minus 10%, but some years it could be even plus 30%. But average over a 10 to 15-year period, 7% is doable. Maybe you can be even conservative, like saying 6% is what I'm targeting. So you're just withdrawing 3%. So that means that you have some buffer to take care of inflation, that your portfolio, you're not catching up to that. And even if you do, if your retirement horizon is life expectancy post retirement is maybe 40 years or 45 or 50 years, it will take time to even chip away mathematically that entire portfolio to become zero, because that whatever money is there, it will also keep growing at 6%. So let the maths do the talking. And at least so far, we've been letting it do the talking. And guess what? Interestingly, again, the last 3 years, the portfolio has been growing. And even with inflation adjusted, our expenses, we are still finding it difficult to expend that money.
What could be potential risk if I wanted to live just off the passive rental income, which is 1.5 times your monthly expenses? I have separate savings for kids' marriage and medical emergency. This is a very specific
Yeah.
question, but yeah, this is
So I
like
think, see,
relying on one source of income. So
see,
that's
ideally, if you can live off your passive income, theoretically, your portfolio continues in perpetuity. So let's say that you've got rental properties and your expenses, annual expenses, um, including taxes, by the way, make sure that you have the taxes in, are less than your total passive income. That means your passive income is enough to sustain your life. That means you're never touching your corpus. So that means your corpus capital growth will continue and you will continue growing in perpetuity. So that's one way to look at it. The other way to look at it is you combine that passive income and that portfolio, because that capital growth is also happening on your portfolio, and you're doing that. But as I said, this is ideal scenario. In practical scenario, your passive income, unless you are just a real estate magnate and you've only got real estate rentals, will have equity, it'll have gold, it could have bonds. So the passive income, there's no passive income from gold, there is very small passive income from bonds, equity, the dividends will be quarterly, etc. So the combination practically is that's why we treat portfolio and passive income together.
how much is your expense increasing every year?
So we have put our own inflation number, and as there was a question earlier also, that what inflation should you put? It should be in the place that you're living. What we typically do is that we look at the inflation in the place where we are living. So right now, Thailand is our main location. And we also say that, okay, how much lifestyle increase do we expect or want to do? So we put our inflation at around 5% here. So which is way higher than the local inflation, because again, local inflation could be the price of eggs and bread and petrol, etc. But the tickets of a movie theater would probably be increasing a lot more. So far we are putting 5%, and within that 5%, we are able to manage our overall expenditure. So year on year, and it's a cumulative increase, by the way. So every year we adjust that with 5%, and then we'll see that do we need to tweak it in future. But this is the number that we have at the moment.
Yeah, I think that's more or less the questions. Any other questions that we missed? If
Yeah. So just go down. This is one more. This is how much percent
oh, this
dividends?
how much is growing on an average annually, considering you have 50% in dividend ETFs and 20% in bonds.
So I think this year we are again. It's still 3 4 months to go. 3 months to less than 3 months to go. We are targeting something around 7%. So let's see that we with the bonds with because we are also doing some rebalancing within the portfolio, buying gold, etc. So let's see if 7% is sustainable. I think it should be. So far, the S&P 500 has already grown double digits. The Sensex has not grown double digits, so some things grow don't do that great. Some things do really good. So overall, the portfolio of 7% is on target, but let's see in the next 3 months how it goes.
And we do own some growth ETFs, both for S&P 500 and for Nasdaq.
Yeah. So that's why overall, I think our equity part has been quite good. Bonds, we had some fixed interest rates of even USD fixed interest rates, etc., which is around 4 to 5%. So that has been so far so good. But there are certain things which is 0% in terms of the portfolio growth. But yeah, 7%.
Yeah, this
Let's hope
is
so.
a good question. So thanks, Mahesh, for this question, because this can cover for us. I think we have already covered in a couple of videos, but so the question is about what would be your advice for last 5 years before firing. So let's say what you do 5 years minus the firing, the time when you want to get fired, and 2 years down the line, and then 1 year before fire. So the process that we actually went through.
Yeah. So I think.
I think, and that is especially in context of, let's say, identifying the activities to
Yeah.
do, so that you are prepared more in terms of spending your time.
So Mahesh, this needs a proper 1 hour video actually. So it's a lot more detailed, and I think we may have covered this in quite a few videos. But if I have to sum it in a minute, the 5 years before firing, the first is that make sure that you take a stock of all your the total portfolio and start tracking diligently. Take a stock of your monthly expenses. So we started doing this 10 years before firing. So if you are just 5 years before, you should by the fifth year already have very good analytics that this is how much your year-on-year expenses is growing, this is how your salary is growing, this is how much your overall portfolio is growing, so that you can see that how much of your salary you're using towards your expenses and how much is your portfolio contributing towards your expenses. Ideally, by rule of thumb, I have to check exactly, but around 30 to 40% of your expenses should start being done theoretically by your portfolio growth itself, the overall portfolio growth, not just passive income. And it's theoretical because you're not going to withdraw that you started using it as expenses. You're still going to use your salary for expenses, but that should already happen. Somewhere around 3 years before firing, you should already know where you want to retire, because at least have a long list, start evaluating, because you don't want to be in the last day of your retired corporate life and getting into retirement not knowing where you want to retire. Make your evaluation criteria. We have a full video about those evaluation criteria. Start stress testing.
Even if
that
it's a different
criteria.
city in the same country,
Yeah,
it need
doesn't
not be
matter.
that you have to move the country every time. That okay, if I'm not looking at different country, I don't need to evaluate. Maybe you need to evaluate city. Maybe within the city, you might have to evaluate that. Do I want to stay in the same house, or do I want to stay at a different place, or do I want to travel? So I think those things also you should consider.
Then the last 2 years of your, you should be already pursuing your hobbies, etc., on the sideline, what you want to do during your retired life. And these could be some of the hobbies that you are just going to do it. Like I do mentoring, I do coaching, I do trainings. I started doing this on a pro bono basis in the last 2 years of just as a hobby to see that will I even enjoy. We did not do this YouTube channel as a hobby, but we started doing a blog, an anonymous blog that time, to see that is this something which we enjoy. So start doing all those things. Start, and the last year, I think it should be even in the 5 years, but last year, you should be super connected with your family and your wife, because people think firing is a lot more numbers, and believe me, numbers are very important, but they are very small of percentage of retirement. Because if you are not connected as a couple, if you do not know that is this something that we want to do together, are there things that you enjoy doing together, things that you enjoy doing separately, so make sure that that communication channel already is open, and you are fully aligned in the last 1 year of fire. So I hope that this kind of gives you a teaser. We do have, I think, a video where we have addressed this. So RP saying if there is
5 years away from achieving my fire number, so practically on coast fire, can I experiment with my job and try something else which might pay less, but then I get to try something?
Yeah, see, financial independence is not that you are basically ready to retire. Financial independence is basically that means that you have money to make such a bold decision and say that you want to coast fire, even pursue your hobby, and if it doesn't work out, that you can come back to the corporate world. That's actually financial independence. So that's a great thing to do, that you can test out those things. But I think maybe 5 years may be too long. You may even try it for 1 year and see that how it works.
Thanks for sharing several do's. Any do nots?
Good point. Very good question.
I think one thing which we already shared, that that one more year thing that we keep saying, that I mean, it's again, it's not a complete do not, that you don't do this thing, don't do that, but it's more about when you can say that enough is enough, right? That's very important. So again, do not fall into that trap of one more year, that if I can just work one more year, get this bonus, get these stocks, get this much income, or save this much more, grow my portfolio. Because that's what we are realizing. We did that, I think, for a couple of years, and I mean, we have been asked also, if you have to do it all over again, what are your regrets? I think the only minor regret we have is, and that is more because of this, the whole health situation, that we should be able to enjoy our traveling, enjoy our hiking and all that. I think we should have done it 3 years back.
Yeah. So if I have to summarize in one line itself, would be, because there's a lot of do nots that probably we'll have to also think about, is do not just think fire is numbers. Because we spend a lot of time, and even in this chat, we've talked about the withdrawal strategy, we've talked about the 2%, 3% bucket strategy, etc. They're all very important points. But retirement, if you really want to retire, not just become financially independent, then do not just be in the numbers. Which means, like Seema said, do not ignore health. Do not underestimate the relationship that is so important, because the day you retire, you will be 24/7 with your partner, and you may drive each other up the wall. So you have to make sure that you don't underestimate that. The third is that do not underestimate the time, that the social circle's importance, which is the family and friends. And do not overestimate the corporate network, because corporate network, as I said, vanishes away very quickly. At least that's been our experience, that they move on, that they just continue there. So I hope that this kind of helps, and this definitely do not is a food for thought. We'll probably think a lot more and maybe even address it in a separate video. So I hope this session was useful. I think for folks, and especially in Melbourne and other places, it'll be really past midnight by now. So,
and this was our first session. So if you really like the session, the way the format is, the Q&A, how can we make it more meaningful in the next session? We would love to do these kind of sessions. We would love to hear your thoughts. Not only questions, but your feedback about our journey, feedback about the channel itself, feedback about the content. So please do comment on this video or other videos and provide your feedback, so that we can collectively make this channel a more
it's like the community itself, so that we can help each other. And if we have missed out any questions, please feel free to reach out in the comment section when we put this video out. We'll try and address it. We try our best to reply to each and every comment. And if there is because there are a couple of personal situations, I think it'll be better if you reach out by email. Our email will also be there, and we can have a one-on-one session, and we can try and give you our guidance and our inputs. Again, as Seema said, that we are not financial advisors, but we can just share our experience. So thanks a lot. Thank you, everyone. And thanks for your encouragement, and thanks for this community. And I really hope that we can set up some physical sessions like we did the meetups in Delhi, in San Francisco, in Singapore. So we can organize some community meetup. And interestingly, I think in the US, people like Carson and Big ERN, etc., they even have a 2-day meetup somewhere. I feel very jealous, and we should do our own 2-day meetup somewhere. And if people are interested, we can try and see if we can organize it in future.
So thanks a lot again for your questions and for this really great session that we actually had. Very engaging session. So thanks for your comments.
Thank you. Thanks
Thank
a lot.
you. See you in the next video.
Bye-bye.